Thanks for checking out this video from NetPicks, and today we're going to talk about the money flow index. Now, generally, when people are talking about the money flow, they talk about the RSI as well, and it makes sense. You know, they're both momentum oscillators. The difference is they use different calculations in how they're plotting on the chart. Of course, the RSI, it's definitely the most popular of the two, and it uses the change in price as well as how fast that change in price is occurring. When we talk about the money flow index, it's going to measure the price change as well, but it also uses the trading volume that's flowing in and out of the instrument that you're trading. Now, since it is more popular, that being the RSI, the question comes up, which one's better? Now, just because an indicator is popular, it doesn't make it always the best one to use, especially for each trader. Now, when we talk about the inclusion of trading volume, will that make the money flow index, I'm just going to say MFI for short, does it make it better than the RSI? Well, they're going to be interpreted the same way. So the best way to decide which one to use is just to compare them. So the MFI, just like the RSI, is going to oscillate between 0 and 100, right? So it's a bounded oscillator. The difference really is the MFI has oversold and overbought readings at 20 and 80, while the RSI is going to use 70 and 30. So essentially, when the oscillator reaches one of those levels, traders are going to look for a reversal in price. For example, a reading of 80 would indicate that the instrument is overbought, and that is primed for a reversal. Now, it's a sign, it's not a guarantee, okay, and a trader is going to want to confirm with price action. So when you see a rise in the MFI, it's going to indicate that buying pressure is increasing and we have potentially a strong trend upwards, right? So it's called positive money flow. When we get a drop in the MFI, it's an increase in selling pressure. So negative money flow. Now the buying and selling pressure, it's not just measured with price changes. It's also measured with the increases and the decreases in volume. Now, also no different than the RSI, we can use it for divergence, which is simply when price is heading in the opposite direction of the indicator. So think of negative money flow or positive money flow as the direction of the indicator. So when that's happening, when they're going in different directions, we could be looking at bullish or bearish divergence. So this stock chart here, it's making higher high, while both the money flow index, which is the top indicator, and the RSI, they're both putting in lower highs. Now both indicators are set to 14. So a trader would interpret this as the upside momentum of the instrument is running dry. So if you're long, traders would aggressively manage their protective stops. And if you weren't in the market, traders would look for price action to confirm that momentum is in fact lessening in the price and look to trade short perhaps. So I think it's important that every trader knows what an indicator is showing and how that's calculated. I think it's really important. But we live at a time when virtually anything can be programmed and you can just pop it on the chart. So if you're a trader that believes that volume is important to trading, and yes, there are people that don't believe that, you're going to be happy to know that volume is used with the MFI. There's actually a few different steps that are involved in the calculation. It includes a typical price, positive or negative flow, and the money ratio. And generally, people use the 14 periods, but feel free to adjust that. Just don't spend so much time trying to over-optimize a perfect setting. Now, it's a much different calculation than the standard RSI, but essentially, we're just looking at momentum with the addition of volume to aid in measuring that momentum. So when we look at comparing them, let's look at a few stock charts. We're going to put both indicators on the chart and just see what information it would have given. So here at number 1, both indicators gave an early warning to an overbought stock, and you can see it quickly reversed. The second one, they both show oversold and bullish divergence. So in this head-to-head battle, both indicators gave the same alert to the state of the instrument, including the oversold levels, right? Even though they're at different settings. This is Tesla, daily chart, currently in a trading range. The MFI gave an oversold reading at the low of the trading range. The RSI couldn't break down far enough to give you that. And the price reversal is clear on this chart, as is that reversal candlestick right off the low. So a trader who looks for oversold signals in the RSI and potential reversals, they would have missed this chart. Let's go to a day trading time frame of 15 minutes. This is Baidu. All right, there's some things that are interesting on this chart. Both oscillators picked up that first oversold condition, and that led to a move up in price. Interesting enough, in the middle, the MFI picked up bearish divergence, while the RSI showed the overbought level was violated. So both indicators did give a signal at the same location on the chart. So the difference is the money flow gave us divergence, while the overbought condition came from the RSI. Now, clearly, this is not going to be an exhaustive test. Okay, it's just to show both indicators at the same point in the chart. But let's remember, both indicators are described as momentum oscillators, right? So they're looking at how they react to changing momentum. To me, that's important. And honestly, I'm not a huge believer in using oversold conditions or overbought readings in my own trading as a main way to get in and out of trades. A market can stay oversold or overbought, as noted by an indicator. You'll see it for a long period of time. That's not going to automatically revert to a reversal. But divergence, that's a different story, because if price is making a higher high in an uptrend, but the MFI, using volume as well as price, is showing negative money flow, we should quickly see if that's valid, right? So we can expect that within a reasonable amount of time, depending on what chart you're looking at, price will either decline or it's going to make further highs, saying that there's no divergence. And I personally like the consistency of the MFI with showing divergence as opposed to the RSI, just because I prefer looking at divergence than I do oversold or overbought. Looking at the 60-minute crude oil chart, MFI shows bullish divergence, right? Positive money flow. The RSI gave us 0 heads up of a potential move higher. So if I had to choose one, I would personally go with the money flow index over the RSI. And I say that because of not putting too much stock in trading an oversold or overbought instrument. That's just not something that's important to me. And I can know fairly quickly if the oscillator is giving a reliable trading signal with divergence, because price will soon follow. And for a momentum indicator, that's what I would want. So the question is, which one are you going to prefer? I would like you to put that in the comments below. Feel free to ask any questions about this. Hope you subscribe, hit like. Talk to you soon.